this schema is shared at the end, but today we're going to share at the start. So from 1 to 10 employees, you do not need a CFO. You just need a good accountant that have the potential to work with numbers, to do invoicing, credit collection, and also to start playing, be comfortable on generating data, play with Excel, budgeting. So it's not the classical accountant that is doing only data entry and invoicing, but someone that is capable to understand numbers. Is not a stretched accountant. From 10 to 100, you start specializing a little bit the accounting team. Probably you have to split the accountant, need to get rid of invoicing and credit collection that can be given to a junior person, and budgeting is becoming more and more important. So this accountant should have some kind of seniority. When you go from 100 to 500 employees, it's time to hire a CFO, because the complexity is huge, but especially because you need to start deploy serious software. I mean, ERP, accounting software, business intelligence and data reporting, a capability to produce financial data 10 days after the end of the quarter. That should be a capability you should have from day one. But and also the passive passive and active cycle, like invoicing and credit collection, should be splitted to have more focus. Then when you are at 1000 employees, 500, 1000, based on your company characteristic, you should have a person in charge of taxes, especially if you have multi offices or specific problems. For example, transfer pricing is a topic. Pricing team, I mean, if pricing is important, having a person or a team that is in charge of pricing, we already know that this can move the needle. Legal, based on the industry you are, can help you on compliance, privacy, and AI, which is now the big topic. But also can be a great partner on the sales team, creating the right MSSA if you sell enterprise, to handle rights, to handle red lines, and so on and so on. And if you are an acquisitive company, M&A, it's a team you should have. And also, if you are a public company, investor relationship, it's a team um, you should have. So this is my preferred framework of report quarterly financial data. What is quarterly flash data? Flash data are at the end, at 10 days after the end of the quarter. So if it is Q3 and in September, 10 of October, you should be capable to send a flash news to your executive, shareholders, board, and shareholders, if you have a limited number of shareholders and you are not a public company, by the way, with those numbers that are good enough to picture how the quarter went. So first of all, billings. What I say? Well, billings are the invoices, the number of invoices issued. Revenues are, sales, but prorated to competencies. Like if you are at the end of Q3, probably one fourth of the revenues are for this year, one three fourths of the revenues are for the next year. So it's a prorated. ARR, we all know what is ARR. We report free cash flow, EBITDA, rule of 40 attainment. Rule of 40, it's revenues grow minus EBITDA grow or loss. I mean, profit or loss. Then you move to another table, which is more quantitative, like how many new customer you have onboarded, how many customer have churned, total customers. I mean, previous quarter customer plus new customers minus churn equal total customer. Average ACV, new customer ACV. What is the difference? Average is the average ACV you have. New customer ACV is the average ACV for this specific quarter. The difference between the two shows if you are increasing or decreasing your ACV. Moving to, then you have a commentary, which is words a set of words, let's say 4 or 5 rows, that explain the dynamics of the quarter. So, what are the columns that are shown in the table? So, the first two columns are actual, means quarter result, and the difference, and the second column is the budget. I mean, forecast versus actual. And the difference is if you are above or below the budget. Then in the semi-last column, same quarter last year, we're going to compare the actual quarter in column 1 to the same quarter last year, column 4. Why I love comparing same quarter last year and not previous quarter? Because previous quarter have huge seasonality, same quarter last year usually should have nice same dynamics. And then you map the difference. I mean, we are above, below the same quarter last year, what is the percentage of growth, etc., etc. Moving to the next, three interesting concepts: price leverage, total addressable market, CAGR. Price leverage is the potential to increase your price and the potential of the market to digest price increase. The more they can digest price increase, the more you can increase the price and having more revenues without acquiring new customers. Total addressable market, we all know, can be big or small. Sometimes people focus too much on total addressable market and too little on how to sell. CAGR, it's a KPI, it's the what I call the fake it until you can make it KPI, or fraud KPI, because usually a CAGR, which is the average growth of the past 3 5 years, whatever it is, it's shown when your revenue growth decrease. What I mean, if 2 years ago you are growing 60, past year we are growing 30, and this year we are growing 15, the narrative cosmetics shows that it's better to show a CAGR of 30%, which is the average of the 3 years, instead of showing your actual rate, which is 15. So every time someone shows you a CAGR, for me, it's a red flag. Who are the stakeholders? Stakeholders means people that have interest in the company on a very huge it's a very huge concept. Um, Forget about the number of the percentage, they should not be there, but stakeholders can be employees and their families, board and committees, investor and market, customers, suppliers, consultants, union, everyone, literally. Usually people, stakeholders organize themselves in groups. For example, we have seen from the HR lesson that there are ERG groups, there are board committee, external stakeholders can be union groups, etc., etc., etc. So every stakeholder can organize themselves in group of interest. What is CSR and ESG? CSR is the social corporate responsibility. It's like something, the ethics of the company on a broad scale. We have seen from the very early slides at the start of this training that I say that we are doing business, but we should leave the world after us better than it was. Someone thought that putting a rule like metrics called ESG inside the social corporate responsibility should be enough to quantify how the company's ethics, which for me is a big fraud, or anyway it's useless, especially because every time you put some kind of metric there is some way to tweak it. And for example, let me show you what happened with Elon Musk. Elon Musk tweeted last year that Philip Morris was scored 84, so a tobacco company had an 84 score of ESG when Tesla had 37, which is but on top of that, Tesla had 37 when Shell and Exxon have a higher score, which is an oil company. So you can see how ESG is useless in the business. That said, why people are still focusing on ESG? Because when you are, this is the table of some corporate bond issued, okay? If you are ESG aware, there are funds that buy debts only from ESG aware companies. So if you are not ESG aware, there are less people, less funds, less people willing to buy these debt. so you have to pay a little bit more in terms of interest. You have to pay a premium. So that's why ESG is still important from just a financial perspective, not from an ethic perspective. Another concept I really, really love is ERM. ERM is an exercise that every year the executive should do, mapping the company risk uh, under two, looking at this risk from two lenses: likelihood to happen and impact. So, impact is the severity of an event that happen in the organization and the impact that this have on the organization itself and in the business. Likelihood to happen is the percentage, the chance that this event can happen. So you can have an event, a risk that happen very often but have a small impact, or a risk that happen once in a lifetime but undermine the company's survival or the survival chance. And this is mapped into this quadrant, which is the ERM quadrant, where we have likelihood to happen and the impact. And they made a couple of example. One risk can be employee litigation, which I mean is not happening once in a lifetime. Happen. I'm not saying often, but it's not a rare case. But I mean, every litigation is not usually undermining the company's survival. But if you have a cybersecurity event that put you offline 15 days, this probably is not an event that happen every day, but the impact will be probably at the survival level. So how this works? Usually auditors in the organization made an interview every executive that, and it's that they ask what are the risks you have identified, likely to happen, and impact. And then they put it in a list, they made the average, they speak together with the executive, and then they release this chart. By the way, when I was interviewed, I say that for me a solar storm that had an impact on the electric infrastructure was a risk that have a huge impact, but likely very very little likelihood to happen. And I was the only one that put the solar storm as company risk. But let's say it was just an anecdote. Um, there are board is organized by board and committees. So board is the whole group of board, and then you have a set of board member focus on specific committee that can be audit and governance, compensation, etc., etc. And then you have other people working shoulder by shoulder with the board, which are auditor, counselors, consultants, many others. Another thing for the governance: if you are a public company or if you work in a highly regulated environment, you have to give the possibility to people to signal, to report specific problems that happen inside the organization, non-compliance, fraud, whatever. And usually people are not feeling comfortable to do it reporting to their manager. So there are these tools and these processes called whistleblowing tools, which are an anonymous software where everyone literally can report if there is something wrong in the organization. And it's a nice tool to provide transparency. Mistakes to avoid in the journey: adopting tool later in the journey. As I said, you need robust systems. So when you are a CFO, usually you need to have great accounting software, great reporting software, great ERP, etc., etc. Not having seniority in the right timing: hiring a CFO too early, it's a problem, but hiring too late, it's another problem. Not having in place in the right structure in terms of IP, tax, and entities. IP means intellectual property, where the intellectual property has to stay, tax, intercompany tax, entities, where I open my holding, etc., etc. These are strategic elements that need to be, managed carefully. And then not having in place right rituals and reporting. The number reporting, the flash news is the one that I really love the most. I do not consider myself a great leader, but the next chapter will be leadership pills.